Welcome back, everybody, to another webinar of the webinar series organized by Princeton University's PCF. We're very happy to have Arvind Krishnamurthy with us from Stanford. Hi, Arvind.
Hello, Marcus.
Arvind will talk about a joint paper with me, so that's a novum. The title of the paper is Corporate Debt Overhang and Credit Policy. So we're hoping to get a lot of critical questions from you today, because I might not be too critical, might be biased. So we're looking forward to it. But as usual, we will do the regular setup. So we'll go back and forth. What did we do last Friday? And what will come up next week? So last Friday, we had Eric Hurst talking about the US labor market during the COVID crisis. Some real-time evidence. He had some payroll data covering 1/6 of the US workforce. So it's a huge data set and gives you a detailed, up-to-date insights what's going on in the US labor market. Today, Arvind will talk about corporate debt overhang and credit policy by the Fed and the Treasury. That's related to earlier webinars we had with Nelly Lang, who outlined all the Fed programs, Jeremy Stein, who was talking about the venture capitalist of last resort, of some different way of considering Fed policy, and Dale Duffy, who was talking about redesigning the US Treasury market and some market liquidity issues on that. And so Arvind will touch on different aspects, but it's in context of what you have heard earlier. And then next Monday, we have Mike Spence talking. So on Friday, we won't have a webinar because of the 4th of July weekend in the United States. So you have to wait till next Monday for another webinar. So with this quick overview, I would like to say a few words about central bank interventions more generally. You can view central bank intervention as a tail risk insurer. So it will take some tail risks away. You can do this by acting as a lender of last resort, or the central bank can act as a lender of last resort, a la budget. And that's like a funding provided through funding liquidity against collateral. You submit as a bank collateral to the central bank and get some funding. You can also, as a central bank, immediately buy assets, and you can do it conditional on something bad happening. So you stand ready, you backstop. You say, I'm ready. If you have to sell something, you can sell it to the central bank. Or you can also act as a market maker of last resort, where you say, okay, you know, the market functions are not working anymore. And then you intervene in helping the market makers, or you become the market maker in order for the secondary market to function well. So when people want to sell existing claims rather than newly issued claims, and that's what Daryl Duffy was talking about in his seminar some weeks back. Now, let me just highlight some aspects which are very different from the 2020 crisis to the 2008 global financial crisis. I think one major difference is that you had a huge buildup of imbalances. The housing stock, there was overbuilding in the United States. There was a huge run-up of credit, especially in the household sector. And the banks were thinly capitalized. There were a lot of shadow banks involved. While this time around, you know, things were much more well balanced. There was not of these imbalances building up. Of course, we had some issues. US government debt was not sustainable, and it's not sustainable now. And the corporate debt was leveraging up. The corporate sector was leveraging up a lot. So these were the issues in 2020. So it's a different way, but overall, there are no real balances building up to the same extent we had in the before the global financial crisis. Then we had a trigger, and what triggered the crisis in 2008 was essentially a revaluation of the housing prices. So real estate was reevaluated, and we had a lot of financial products which were misestimating correlation of house prices across the United States, and that led to a huge revaluation of real estate and financial products attached to real estate. Now, it's not really a revaluation, not the stochastic discount factor, which is shifting a lot. It's really the cash flow, which is changing a lot. So it's the cash flow, not the discount factor, which is driven. And I think the one emphasis we would like to stress here is that 2008 was the household sector and the bank's balance sheets which were impaired, leading to amplification. Right now, it's the corporate sector, much more touched upon. Of course, household sector might be touched upon too, but it looks like it is primarily the corporate sector. And of course, the banking sector so far is still sound, But we will see how long this will hold out. And then what was the weapon of mass destructions in the 2008 crisis, a la Warren Buffett? It was CDOs. Now we have more CLOs, which are on the loan side rather than on the mortgage side. So we have to much more shift away from mortgages towards corporate loans. But the policy objective is also very different. That's very, very important to understand. The policy objective of 2008 was to stimulate demand, get demand going again, and shift essentially some demand from low marginal propensity consumers to high marginal propensity consumers in order to get the aggregate demand going again, in order to stimulate the economy again. Right now, stimulus is not so helpful because there's also, you can't really go to restaurants or consume certain things. It's much more survival issue. And it seemed like in 2008, the crisis was very fast, but in 2020, the current crisis was even faster. It was extremely fast. So with this big picture overview, Arvind then will go much more in understanding where the financial frictions are in the current crisis and 2020 on the corporate side in particular. Now let me just highlight some aspects how one could have seen the whole structure of the economy if we had no financial frictions. If in an idealized world everything would be organized perfectly, we would have an era de Breu economy with perfect contracting, and we would have a contract where we say, okay, if no COVID occurs, then you have to pay a certain amount, and if COVID occurs, you have to pay a different amount. So for example, you have, there's a normal state, there's no pandemic, or there is the COVID crisis, or the pandemic or not, that's the first uncertainty. And then you have to pay, if there's a normal state, you have to pay your rent, let's say, of $1,000 each month until the pandemic is over. Of course, there's a second level of uncertainty, which is, how long will the pandemic last? So that's another element to it. So you don't know how long the pandemic will last. That's a second uncertainty we have to deal with. But let's focus on the first uncertainty. And so you don't know whether in ex-ante in February or in January will the COVID crisis occur or not. And if the COVID crisis occurs, you don't have to pay the rents anymore. And that would be an optimal contract design. You would ensure the landlord would say, if the COVID crisis occurs, you don't have to pay the rent anymore. But we didn't have that. So then the question is, this would be an optimal contract from an ex-ante perspective. Can we implement this ex post in a particular way? And one way to implement this is to say, we introduce something ex post, a bankruptcy procedure. Bankruptcy in the sense of bankruptcy protection. It protects you that you don't have to pay beyond a certain amount. So you can default on your obligation. So you still pay in the first month, but then you go bankrupt and then you don't pay in the second month, third month, and so forth. And you don't have to make the payment, and you replicate essentially the optimal procedure to some extent. Okay. Of course, it has to come along with no eviction, so you will not be thrown out of your house in order to replicate what's going on in this. Of course, there's of course a bankruptcy cost involved. So the bankruptcy cost, that's what Arvind will talk about, whether that's really exposed and can be implemented or not because of this huge bankruptcy costs and evictions and other complications. That's essentially a big issue to consider. Now, another way to obtain this, and that's probably the route we went, is to say, okay, instead of, the government gives the renter $1,000, and then the renter is passing on the $1,000 to the landlord. And essentially there's no default. So essentially the government through the renter is paying the rent for the renter to the landlord. And in a sense, it is the case that the big beneficiary from this whole procedure is the landlord. So it's not that actually the renter is getting the $1,000, literally it's getting the $1,000, but then that allows him to pay on the $1,000 to the landlord. And ultimately who benefits from the whole thing is the landlord in the case of a rent. But if you think about credit card companies, it's a credit card company, or the asset holder holds the credit card receivables. They're ultimately the winner of all the government subsidies. So it doesn't really go to the guy who gets an unemployment benefit gets a transfer, because of the unemployment benefits, he's now able to pay off the rents, he's able to pay off his credit card bills, and that ultimately benefits then the credit card company or the landlord and so forth. And then the question is, ultimately somebody has to pay for that, and we have to tax somebody at the end. And that gives us, for this perspective, gives you an insight who should actually carry the tax burden at the end. Because if you had to written the initial contract with this ERDB contract, the payment would not have occurred, because it said whenever the pandemic occurs, you get 0 payments. Now, suddenly, they get still the $1,000, and then probably the tax has to be levied on the entity which gets the $1,000, the landlord or credit card company, and so forth. Now, with this, I would like to conclude and end as usual with a poll. And here are certain 4 poll questions today. And so I would like to ask you what you think is, what's a key economic concept for the COVID crisis? Is it demand management? So we have to distribute high MPC consumers, high marginal propensity consumers, or do we have to impair balance sheets? So it's much more on the corporate side, impairing balance sheets. Of course, it could also be other balance sheets from others, but it's more the impairment of the balance sheets which causes the problems. The second question is, focus of the COVID crisis should be on the household sector, mortgages, credit card debt, and so forth, or on the corporate sector, which is much more out of debt overhang of the corporate sector, zombie firms, and so forth. And the third question is, who should actually be taxed to finance all these crisis transfers, which, you know, the government is paying out now, but at the end, somebody has to finance it. Somebody has to pay for that. Should it be levied on all the citizens? Or should it be levied more on, you know, the asset owners who benefit from this transfer payment? So they should actually have a higher tax burden than all the citizens. Or should it be even be levied on entities which benefit from the crisis because it just works in favor of Amazon, whose revenue is boosted up, or some IT firms, Zoom, and so forth? They have huge windfall gains, and there's some of the windfall gains have to be passed on from them. And finally, the fourth question is, should we avoid bankruptcy at all costs? Because, you know, COVID is nobody's fault, for example, it's no moral hazard issues. Or should we allow bankruptcy, particularly if the bankruptcy costs are low, because it's like an ex post contingent implementation of an ERDB security. So I wait another few seconds. The weights are coming in very fast, and if you move fast, you still have a chance to vote or be part of the poll, express your opinion. Okay, let's say the key concept, demand management and impaired balance sheets. 42% think it's demand management still, so we have to focus on MPC consumers, you know, moving wealth from low to high MPC consumers. That's, for example, one thing. And 58% think impaired balance sheets are the more important component. And the second question is, what's more important, household sector, mortgages, credit card debt, and so forth, or it's more important the corporate sector, debt overhang, zombie firms, and so forth? And this is a multiple choice question, so you can pick both. And 59% think it's the household sector, but 67% think it's more the corporate sector. So it's very different this time around than it was in the global financial crisis, in particular in the United States. But there's also a large proportion who still think the household sector should carry a lot of weight, mortgages and credit cards. Who should be actually paying ultimately for all the government transfers we have seen? 35% think all citizens. Again, you can pick more than one question, so all citizens should be levied on it. The asset owners whose assets were supported indirectly through the support, the asset owners benefit from that. That's the majority, 56% think that should be levied on them. And the firms which benefit because they accidentally turn out to be beneficial for them, 46% think should be, the tax should be focused on them. Again, you can pick more than one, so it adds up to more than 100%. And finally, should be bankruptcy avoided at all costs? 17% only think, but 83% think no, bankruptcy might be an ex post contingent implementation of an ERDB security ex ante, and that's what 83% think. So with this, I pass on the screen or the floor to Arvind, and we're looking forward to Arvind's presentations.
Okay, thank you, Markus. All right. First of all, thank you to this audience for tuning in. I know you're used to hearing Markus quiz on your behalf other economists. Today, I'm going to be presenting work that is joint with Markus. So Markus will quiz me, but you should really quiz Markus as well about what we're doing, okay? So just to start, just to emphasize some of the things that Markus said, which is very much the way we're thinking about the world currently. We enter this recession after a decade-long increase in corporate leverage, and the credit dimensions of this recession are currently very much sitting in the corporate sector, and policy understands that. The Fed and Treasury's corporate bond purchase programs, the Main Street lending programs, and the SBA's paycheck protection program are really about easing credit conditions in the corporate sector. So that's one aspect of the analysis which we're going to be doing, which is about understanding credit policy in the corporate sector. The second thing that I want to emphasize, and Markus also emphasized this in his intro, is that the way we are thinking about this recession and we're thinking about the objective of policy is very much about insurance. In 2008, there was also an important credit dimension to the recession, and the objective of policy in that case was to fix credit problems in the banking sector, to allow for credit to flow smoothly, as well as to help repair household balance sheets so that you'd stimulate household spending. The way we're thinking about this policy, the world currently is really about insurance. It's about preventing scarring. So in some sense, if you looked at the world in January of this year, there was a blueprint of the economy that worked fairly well. This pandemic hits, and as we are going through the pandemic and as we recover, the frame of mind that we have in looking at the world is that the blueprint is largely still appropriate for the world at exit. Now, that's a broad statement, and surely there are exceptions. In almost any, given any economic shock, there's some amount of reallocation and shuffling that has to happen. But our perspective on this recession as opposed to past recessions is that a lot of it is about just ensuring that the blueprint is still viable and that the matches and the firms and households and supplier downstream relationships still continue to be in place after the recession ends. So it's really about insurance to prevent this type of damage. So what I'm going to try to do in this talk is I want to talk a little bit about some of the distress in the corporate bond market, spend just a few minutes talking about things the Fed did in March and April, and then the bulk of this talk is going to be about the credit problems in the corporate sector and how policy can beneficially affect these credit problems. So I'm going to start with this picture. This is a picture of corporate bond spreads. If you look at the left panel here, we're tracking corporate bond spreads on high yield, so junk bonds, as well as investment grade bonds since the beginning of this year. And you should think of corporate bond spreads as really reflecting two things. One is the probability of default times the market price or the risk premium on default risk. Okay. As we trace through to the start of the COVID crisis, you can see that spreads rise across the board, both on investment grade as well as high yield. And one of the noticeable things from this picture is really that the large rise in spreads in the early part of March. And there's considerable evidence that what was happening in that period was really a reflection of dislocations in markets. There was illiquidity problems in in markets, as well as problems of segmentation and reduced risk capacity. Just to illustrate that point, the right panel here plots for Google, Google's CDS spread in orange and Google's corporate bond spread in blue. This is a picture from Haddad, Morera, and Muir. And you can see here just a clear example of dislocations in asset markets. The corporate bond spreads rise in mid-March in the neighborhood of 150 basis points with almost nothing happening to the CDS spread. So asset markets, supply-demand forces, illiquidity, these are very much front and center. And what I'm graphing on the right is really sort of a CDS bond basis. And those of you who are students of the last financial crisis knows that there were many examples of this type of thing that happened last time around. So the Fed has acted very effectively in dealing with these problems. To some extent, this CDS bond basis that we're illustrating here is the type of thing that the Fed dealt with very well in 08. They figured out how to deal with this, and calling back to the 08 playbook of liquidity provision, as well as adding risk-bearing capacities, seems to have dealt with this problem fairly well. And I want to say a little bit more just about the risk-bearing capacity aspect of what the Fed did. So on March 23rd and again on April 8th, the Fed made announcements that they would stand ready to purchase corporate bonds. And what's interesting about both those purchases is these announcements is that they've worked extremely effectively. They have restored market function. Again, go back and look at this picture. Google's bond spread basically by the end of March is back down. So in some sense, the Fed's announcement has catalyzed the private market to step in. We know from other data that bond issuance has picked up. So a lot of this dislocation has been taken care of. The Fed has been fairly effective of this without actually buying anything. And the way we think about this is it looks to us like what the Fed has done with its bond purchase announcement is that they've acted in a way as a sort of market maker's last resort. It's a commitment to take out tail risk. Here's a quote from the Fed statement about the primary market credit facility, which is it's a funding backstop. And this funding backstop has worked fairly well. Now, the corporate bond programs are small, but they're just rolling out. As I say small, really just in the last couple of weeks, the Fed has been purchasing. And right now they've purchased on the order of 40 billion. So one of the questions which we want to think about is, does it make sense to continue this program? Or should the Fed just keep this program as a backstop to take out tail risk? Or should it step in more aggressively and purchase corporate bonds in an attempt to bring spreads down even further? Let me come back now to this picture. So we go through March, there's a spike in spreads, which, as I said, is a reflection of higher risk premia and illiquidity problems. The Fed seems to be very effective in bringing those issues down. By the end of May, early June, spreads are still elevated relative to where they were early in the year. But this elevated spreads, since our market prices of risk and liquidity conditions are more or less normalized, is really a reflection of default risk, right? High yield spreads are roughly double where they were at the beginning of the year. That's a reflection of higher default risk in the high yield space. Why are default risk higher? Well, it's really two things. One is, as I mentioned earlier, we come into this episode with a big increase in corporate debt. And so that shows up as an increased probability of default or distress across firms. The split between high yield over here in blue and investment grade is an example of differential debt. So these guys, the high yield firms have much more debt than the investment grade firms, and spreads are higher in the high yield sector. The second aspect of how default risk is higher is if you look at the cross section of firms. So on the right panel here, we're plotting how spreads have evolved from the beginning of this year in January to late May across different industries. You'll notice that the industries which have been most pandemic affected, where cash flows have fallen the most, so energy and consumer sector, are also the ones in which spreads have increased the most. So to some extent, what has happened in the distress in the corporate sector is both a conjunction of high levels of existing debt, as well as a shock that is differentially affecting industries across the US. Here's another plot to make this point. What we're graphing here on the left is a histogram of corporate bond spreads across the traded corporate bond sector. So this is data from Trace. And I'm just going to start by talking about the blue graph. The blue graph is pick all the corporate bonds in the Trace data, graph corporate bond spreads as a histogram, and that's this blue curve. The orange curve here is the same histogram, except it's now plotted once the pandemic has started. And so if you compare the blue and the orange, the thing that's most noticeable is really twofold. One is spreads have increased, but second, and in a way just as perhaps more significantly, there is a big right tail in these spreads. So the corporate sector has reflected an increase in dispersion of risk exposure as we've gone through. Many, many more firms out on the right tail. And as you would expect, as more firms shift out to the right tail, more and more firms are hitting financial distress and bankruptcy. So on the right panel, this is a plot of large corporate bankruptcy filings. It's a monthly count. The last count that we have in this graph is May, and you can see here the bankruptcy counts are now approaching where they were in 08-09, and judging from the behavior of spreads, it's reasonable to think that we're going to exceed where we were in 08. So that's the sense in which this COVID recession is a recession that is straining the corporate sector. It's pushing many more firms into distress and many more firms into bankruptcy. The data I'm just showing you is data from the large firm, the traded corporate bond sector, where we have a fairly good window into what's happening. Our presumption, our conjecture is that these stresses in the corporate sector are just as strong, if not more severe, in the SME sector, in the small business sector. And that's quite important, and we're just going to proceed assuming that is true. So I'm going to switch to talking about the bulk of our analysis, which is basically a question as to about how credit policy can address some of these problems that have showed up in the corporate sector, and thinking both about the large firm sector as well as the small business sector. So what's the concern? Why is credit an issue here? It's debt. So we come into this recession with high levels of debt, and there is a macro concern about debt, and it's really twofold. Thinking through the corporate finance of debt, there are two sets of issues you worry about. One is bankruptcy costs. So if you're say an automobile parts supplier in the Midwest, and we hit a recession in which demand for cars falls, you're now facing a situation in which the demand for your auto parts have fallen, and you may not be able to meet debt service, and you may have to file for bankruptcy and are then liquidated. So there's a concern about high levels of debt triggering inefficient liquidation. A viable firm that has enterprise value, say post-pandemic, is liquidated during the pandemic, and the concern there is that when the pandemic is eventually over, the recovery will not be as fast. So that's one concern that we want to flag and that we want to think about. As I'll emphasize, this inefficient liquidation concern varies across different types of firms, and I want to highlight that in our analysis. The second concern that debt raises from a corporate financing consideration is that debt can be a drag on firm operations. So firms will, with high levels of debt, prioritize essentially making debt service, and that can lead to problems of underhiring and underinvestment that will erode enterprise value. So the longer the pandemic lasts, the high levels of debt drag firm operations down so that firms let go workers, don't maintain the capital stock, and so that eventually, even if the pandemic ends, you start from a capital base that's lower than would have been otherwise. So points 1 and 2 are macro concerns. They're concerns about scarring that'll impede a recovery once pandemic is passed. These are the concerns we want to talk through. And what we want to think through is, to what extent can credit policy mitigate these concerns? And I'm just going to throw 3 types of policies on the table here. One is corporate bond QE. So what I mean by that is, in the last recession, we know that there was a problem of underwater households that was impeding the recovery. And the way that many researchers have thought about mortgage-backed security QE is that we're shrinking mortgage spreads to help the underwater households, allow them to refinance at lower rates. So I want to think a little bit about whether corporate bond QE, applying it to the corporate sector, can have a similar impact. And this is currently not what the Fed is doing. As I said, what the Fed has done currently is they've rolled out a corporate bond program that is acting as a backstop, but they are expanding it, and we'll see how this proceeds. So as a policy matter, it's worth thinking about whether there's a version of a corporate bond QE that can make sense. There's 2 other programs that the government has rolled out which help the debt problem. One is the Main Street Lending Facility. Again, a very small program as of currently. I think my last check was around $30 billion. But this is a lending program that is available to small and medium-sized businesses that help them to obtain credit. And then the last is the Paycheck Protection Program, which is the program that is really substantial. To some extent, all of these programs are credit subsidy programs. These are government-backed programs that offer the corporate sector borrowing at lower rates. So we want to kind of think through to what extent these programs can be useful.
So Arvind, can I interject one question from the audience? Yeah. In particular, June would like to know whether, there was a lot of stock repurchasing and leveraging up. Is this just the punishment for what has been done before, and there's a moral hazard issue? And if you now help out a lot, you're just promoting moral hazard down the road again.
Yeah, so let me say that the analysis which we are going to do, that I'm going to take you through, is a question of the world today. So in the world today, high levels of debt can create damage. And so our question that we're going to ask in this presentation is, to what extent can government policy prevent that damage? Now, there's of course, the ex-ante question, which is, if you prevent damage today, then effectively what you're doing is you're providing a bailout. And so that triggers the moral hazard issue, which is ex-ante. Doesn't that mean that you're going to, in a future boom, essentially subsidize debt? And that is a concern. It's a valid concern. It's not something I don't think we can shed light on right now. I'll come back and talk a little bit about this, because it does come to the question about how the taxes that pay for the subsidies should be sourced. So this is the last question that Markus asked. And then the second point I would make with regards to the moral hazard problem is, and this is just my conjecture, is that the probability of a pandemic, say 2 years ago, I think in most investors' minds was extremely low. So if what the Fed does currently, or what the government does currently, is purely to provide insurance against a pandemic, then that's likely a smaller moral hazard issue. If instead what the Fed does, or what the government does currently, is seen as generically dealing with all types of negative shocks, then that's really the much more severe concern. And that is that's something that policy has to be very careful to draw a circle around. Okay, so let me come back. As I said, the question which we're asking here is this question just about economic damage sitting here today, and trying to figure out what the right way to deal with the economic damage in the world right now is. Here's just a concrete question which we're going to evaluate. So suppose policy could inject, say, $1 into a firm. Where should the subsidy go to maximize macroeconomic benefits? So where should this subsidy go in order to prevent the type of scarring and damage which we're concerned about in this recession? And I just want to start by noting one thing, which is familiar to anybody who has thought through finance, which is that absent a corporate financing friction, that is, if Modigliani-Miller applies, there's really no role for credit policy. The only thing that will affect economic outcomes, and when I mean economic outcomes, I mean really labor and capital policies, is the policy rate, the path of the policy rate. If you were to offer a credit subsidy, so give $1 to a Modigliani-Miller firm, it's not going to change its real operations. If this firm wants to downsize in the face of a negative economic shock, it will do so. What the firm will do is it'll take the subsidy, the dollar, and pay it out as a dividend to shareholders. You'll change financing, but you won't change real operations. So if you want to understand where a dollar can beneficially affect credit, you need to think about a deviation from Modigliani-Miller. So I'm going to think through two cases in which debt causes firm behavior that creates a corporate financing friction. And to us, these two cases seem like the most salient ones. The first case is a case of a large corporation that's run by management in the interest of outside equity holders. So you can think of the typical large public company. You can also think of a private equity-backed company as being reflected in our case one. And as I will make clear, the issue for this firm is one of solvency and debt overhang. In extremis, what this firm will do is it'll file for a Chapter 11 reorganization. That's the bankruptcy process for this case, as I'll talk through. The second case that I want to talk through is a case of a small owner-run enterprise. The issue, as I will make clear for this case, is one of liquidity constraints and debt service concerns. In severe distress, this firm will file for a Chapter 7 liquidation. That's the bankruptcy outcome for this case. So I'm going to talk through both of these two cases, and as I said, think through to what extent credit policy can ease scarring concerns for these two cases. And I'm going to start with case 2, the SME. And as I'll make clear, I think the real issue for this firm is one of liquidity constraints. So let me just talk through. I think this one should be fairly intuitive. So think of a firm in which the owner-manager has pledged, say, collateral for the firm, as well as personal assets towards a loan. And this firm hits this current recession, earnings decrease, and the earnings decrease triggers debt servicing problems, right? So how will this firm act here? The owner's equity is tapped out. So the owner has previously pledged all of his personal assets to the firm. So we have scarce equity, scarce liquidity from the owner's standpoint. And so the owner will be unable to contribute extra resources in order to meet debt service. In that situation, what the owner will do is he'll prioritize using his scarce liquidity, whatever earnings the firm has, really towards debt service in order to avoid bankruptcy. And in doing so, he'll necessarily have to forego some actions that would otherwise maintain enterprise value, right? Such as maintaining the workforce or maintaining capital. So the liquidity constraint means that there is effectively a higher cost of capital for this firm, and that higher cost of capital will translate into actions that reduce enterprise value. Now, if this goes on long enough, at some point the liquidity constraint will turn into a default. In that case, the concern is the firm will have to file for a Chapter 7 bankruptcy, a liquidation, firm assets sold off. And to the extent that the owner-manager has pledged personal assets towards the loan, this firm will possibly file for personal bankruptcy. As I've talked through this, you'll notice that there are really two scarring concerns, two sources of economic damage that can happen for this firm. One is the case that during the recession, as the liquidity constraint is binding, firm value is eroding. So eventually, if the recession ends and the firm wants to scale back up, it's coming back from a lower base. The second issue is the bankruptcy issue. for this case, for this firm, the instance of bankruptcy is a social loss. And I say this because imagine a scenario in which the firm files for bankruptcy. The owner also files for personal bankruptcy, so that exiting bankruptcy, the owner has a little to no capital. Even if you hit a state of the world in which the pandemic is over and this firm's business model is viable, we'll now be in a situation in which the owner will have a hard time scaling back up. He'll have too little capital to put into his business in order to scale back up. So, you know, whatever capital he can put in, maybe he uses that plus some collateral for a bank loan, but it'll take a while to come back up. So the scarring concern is twofold here. And it is in our mind, this is a severe scarring concern for these types of firms. So I think policy understands this. There's a close analogy between policy actions to provide credit to these firms and policy actions to deal with underwater households in the 2008 recession. In both cases, the answer really is to find ways to reduce the debt burden, provide policy designs that provide payment relief so that the firm doesn't have to use scarce liquidity, provide longer loans, so push out repayment periods, and also subsidize credit. There are a collection of ideas that have floated around. I know, Markus, you had Jeremy Stein here a couple of weeks ago talking about this. So there are ideas that I think build on trying to provide cheap liquidity to this firm and dealing with the instance. I'm not going to talk too much about that because I want to switch to talking about the large firm sector. So the second case that I want to discuss is a large corporate, and I think the issue for this case is really one of solvency. It's not one of liquidity necessarily, it's one of solvency. So a firm like this with a high level of debt faces a solvency problem that creates a debt overhang. This is the classic Myers 77 debt overhang problem. And the reason for this is that a firm like this is run by management in the interest of deep-pocketed outside equity holders. And necessarily, a firm with a high level of debt will have an incentive to not maintain enterprise value, because actions that maintain enterprise value to some extent benefit debt holders. And so this creates Myers's underinvestment problem. I'm just going to spend a slide on explaining this maybe in a little bit of detail. And I apologize for those of you who are well versed in finance. I'm just going to take you through some basic finance here just to make the point very clear. This is debt and equity with high levels of debt. So on the x-axis here, I'm graphing firm enterprise value. On the y-axis, I'm graphing the payoff of a debt claim. So the debt claim has the classic hockey stick shape. Below face value, you get, as a debt holder, whatever enterprise value is. If asset value, enterprise value exceeds the face value, then you get a flat payment. The value of debt is just the integral under this of this payment stream, weighted by the distribution of enterprise value, which I'm just graphing simply here as just a normal distribution. So that's the payoff from debt claim. On the right side is the payoff of the equity claim. The equity holder gets the residual. So he has essentially a call option on the firm's enterprise value. He gets paid off if asset values exceed the face value of debt, and at that point he gets a linear value. Again, the value of equity is just the value of this enterprise value integrated using this distribution. So the debt overhang problem is a problem of a firm that has a high face value of debt, in which the equity holder's call option is effectively further out of the money. And in that instance, if you think about an action that increases enterprise value, what that action is going to do, so when I mean increase enterprise value, I mean, say, maintaining a labor force or maintaining capital, what that action will do is shift the probability distribution of outcomes from left to right. And as you'll see here, since the equity holders only benefit if enterprise value exceeds the face value of debt, the equity holders only benefit to the extent that distributions are shifted over to the right here. There's a collection of mass here on the left where enterprise value is higher, but that benefit increases the value of debt, not the value of equity. And if management is being run in the interests of equity holders, management will choose to not take actions that potentially raise value, because some of that value will be siphoned off by the debt holders rather than by the equity holders. This is the classic Myers underinvestment problem. It's really it's in a way it has a different nature to the liquidity constraint, but it has the same outcome, which is that the firm with a high level of debt will choose to not not run expenditures that maintain enterprise value, and in so doing, over time, enterprise value will erode. Right. So that's kind of a significant scarring concern for a high debt firm here. Now, eventually, what this firm will do is it'll file for bankruptcy. If the solvency problems get severe enough, this firm will file for bankruptcy. And the case of bankruptcy for a large corporate is different than that of a small company. And the reason for that is that in the large corporate case, the bankruptcy filing comes with some ability to eliminate the debt overhang problem. So in particular, the typical Chapter 11 filing is a reorganization plan. And in the reorganization, there's two things that get triggered. One is an automatic stay on debt payments. So the debt servicing problems are put aside because there's an automatic stay. And the second thing is that the creditors become the new owners of the firm, and equity holders are wiped out. And in creditors becoming the new owners of the firm, they restructure the firm's debts in a manner to ensure the firm is viable going forward. So Chapter 11, in particular for large corporates, exists as a way to ex post eliminate the debt overhang problem. And I recall from the poll that many of you clicked Chapter 11 bankruptcies as a way of getting over the debt overhang problem. That is, I think that's exactly right. That is the way we're thinking about this. Now, of course, Chapter 11 has direct and indirect bankruptcy costs, and I want to come back and talk about this. But
so
before doing that,
for some questions, Adriano Rampini, you would like to know, many of these programs have actually some real restrictions attached to it. So for example, if you make use of this credit program, you have to invest or you have to hire workers or something like that.
Yes.
Would this then change the whole dimension?
So I think,
okay, let me just add another one, otherwise to save some time. So Robert Owen would like to know, is the problem that we focus too much on a shareholder society? Should we include other stakeholders? If we have a stakeholder society, we would not have this problem. So we have to change essentially the way we run capitalism, and take other stakeholders into account as well, and change the corporate governance. Who is in charge of the corporations? Is this an argument strong enough to change the whole corporate governance structure?
Let me address
perhaps
Adriana's
you can
question.
Come back to this at the end. It's probably
yeah,
a big,
and actually, I think
question.
Markus, you're the person who should talk about this, because I think the comparison of U.S. to Germany is to some extent the comparison of the kind of shareholder society versus stakeholder society. With respect to Adriana's question, I mean, that's what Adriana says is exactly correct, which is that program designs that try to ensure that credit subsidies are used towards real operations are the right types of programs. And the Paycheck Protection Program tries to do this. So does the Main Street Lending Facility. The corporate bond purchase programs do this much more weakly. But restrictions on how you can use funds is useful. After saying that, I am not, I think the data will tell us how effective these types of programs are. I guess my take so far, and this is to some extent a matter of evaluating how programs that have been rolled out currently have done, is that there's some hit and some miss. And I think we'll understand that better going forward. But as a design matter and as a theoretical matter, what Adrian says is exactly right. That is that one would like to be able to tie credit subsidies to real investment actions that go towards maintaining enterprise value. So let me come back to the large corporate bankruptcy. So as I emphasized, Chapter 11 does afford a way to eliminate debt overhang problems. It comes with some costs, but I want to talk a little bit about the decision to file for Chapter 11. This is a quote from the Wall Street Journal yesterday, and I just want to emphasize that the decision to file for Chapter 11 for a large corporate is typically not an issue of liquidity. It's a strategic decision that the firm chooses to file for bankruptcy. So the private equity owners of Neiman Marcus, which is Ares Management, which filed for bankruptcy, had $33 billion of dry powder. So it's not a matter of the equity holder lacking cash. It's a matter of the equity holder choosing to do so. And the finance way of thinking about this is to go to the Leland model. So the way to think about the equity holder's decision to file for bankruptcy is to understand that it is about choosing to purchase a call option. So just to illustrate this point, let me take a case of a firm that has really zero social costs of bankruptcy. It's an extreme case, but it's a case that'll be useful to make the point. And think of the decision of the equity holders of this firm to file for a Chapter 11 reorg. The way to understand this is that the equity holders, as I emphasized earlier, essentially are owning a call option of the firm. And debt service, if you come into a situation where you have a high level of debt and have to make the debt service payment, the debt service payment is like the premium that an option holder pays in order to retain the option. So you make the debt service payment, you avoid bankruptcy, and in doing so, what do you get? Well, you get this payoff, the call option, the equity value of this firm. That's the fundamental decision that's being made for a firm like this. And the logic of what drives that decisions are things that have to do with option valuation, things like volatility and how in the money the option is. Now contrast that, that's the private decision to file for Chapter 11. Contrast that with the social decision. Socially, in a case in which bankruptcy costs are zero, the private decision will always incur delay longer than is socially efficient. And I say that because the high level of debt means that the debt overhang problem leads the firm to, over time, underinvest and erode firm value, even in this case in which there is an avenue to eliminate the debt overhang problem. So that's, in a way, the worry that sits around with large firms. So where does that lead us? If you think about the question of, do you want to provide a credit subsidy for a large corporate? If you're in a world in which the pandemic recession is expected to last a long time or bankruptcy costs are low, then the appropriate policy really is no credit subsidy. Why? Because it effectively enables equity holders to delay a Chapter 11 filing. In the process, enterprise value is eroding and you're essentially enabling zombie firms. If on the other hand, you think a recession is going to be short or the firms that are relevant here have very high bankruptcy costs, then potentially a credit subsidy is valuable because it avoids this fixed bankruptcy costs. So our take on the world currently is, given the Fed's current assessment, and I'm saying this in part because the Fed has publicly made announcements that they are pledging zero rates for the next 2 years, given their forecasts of depressed activity for a longer period of time, it looks to us like we are more in the long pandemic case, which is to say that the right policy shouldn't really subsidize large corporates. Corporate bond programs, in our mind, should be left on standby. They should continue to be this sort of last resort program to be used in event of risk dislocation. And there's really no role in our mind for corporate bond QE. And I say this as thinking about the debt overhang problems for large firms. Now, let me come back to this bankruptcy cost issue, which I've sidestepped so far. The decision to subsidize credit to a large corporate is, as I've just discussed, nuanced. On the other hand, the decision to reduce bankruptcy costs, any reduction of bankruptcy costs is unambiguously beneficial. And this is for two reasons. One is it reduces among the deadweight costs attached to restructuring and having to do with the pandemic. It also effectively subsidizes debt restructuring. So especially for a large corporate, since debt restructuring and a Chapter 11 is a way to limit the debt overhang problem, finding ways to reduce bankruptcy costs allows this to happen more easily. And then the third point, which I want to emphasize, is that it lessens the need for a credit subsidy to a distressed firm. So if you're thinking about subsidizing credit to a distressed firm in order to reduce the debt overhang problem, you can sort of reallocate dollars that you would send to distressed firms into dollars that, if you could reduce bankruptcy costs, and you could do that in a win-win way, because then you need to spend less money on subsidizing distressed firms and more on reducing bankruptcy costs. So I want to talk a little bit about what we think is the right way to deal with large firms, which is to try to find a way to reduce bankruptcy costs. So I'll mention two things. One is in bankruptcy, what typically happens is a firm in Chapter 11 needs cash to maintain operations, and this cash typically comes from a specialized DIP lender, a debtor in possession lender, which is often the same as the senior creditor. So we think that a better way to send dollars into reducing damage in large companies is actually to subsidize DIP financing. So doing so, as I said, essentially reduces one of the important direct costs of bankruptcy. And this can be done by the government in one of two ways, either by directly providing a DIP loan to a firm in bankruptcy, or indirectly, you can subsidize private credit that is being used towards DIP lenders. As I said, both are beneficial because they reduce one of the significant costs of bankruptcy. And we would argue that it's worth doing this even below, say, the riskless rate, to provide a true subsidy to this in order to avoid damage. The second issue having to do with bankruptcy that is potentially a cost is there is a worry that many legal scholars have emphasized that if events play out as forecast in the corporate bond market, the infrastructure for bankruptcy could easily become overwhelmed. And that could also lead to some congestion costs. And so it makes sense to find some sort of way to scale up expertise or to streamline the bankruptcy process to avoid these costs. These both seem like very useful ways to spend money. I say that although there's some evidence that congested courts actually favor continuation, and since the current concern of this recession is over liquidation, it might be this might be less of a concern, but I'm going to say less about this because I'm not a legal scholar. The second thing that is worth thinking about with bankruptcy costs is bankruptcy costs also have indirect spillover costs. There are other stakeholders who are affected in a bankruptcy, and in our mind, probably among the most significant of these are banks. If bankruptcy and distress happens, then banks are going to end up taking losses on their lending portfolio or their bond portfolios. We currently do not have a kind of 2008 style financial crisis, but if the world evolves and more firms file for Chapter 11 in order to restructure their debts, then what is going to happen is that bank balance sheets are going to get hit. And it makes sense in the same way as it makes sense to try to reduce bankruptcy costs directly, it makes sense to also reduce some of these indirect spillover costs by, say, shoring up bank capital. The Fed's actions last week were in this direction. It may make sense to go even further, trigger, say, the countercyclical capital buffer, and have banks issue equity, especially now while markets are operating reasonably well. The last thing that I want to,
interject some questions. So, Georgie, I would like to know whether if you make bankruptcy restructuring so cheap, does it make outside of the court debt restructuring less likely? Are there some negative spillover effects?
I see.
Are there any problems with that?
So I would think it would actually catalyze it because in a way bankruptcy is the outside option here. So if you are doing it outside, then maybe you make it cheaper beforehand. But I have to think about that a little bit more before giving a firm answer, but that's a great question.
And another question is concerning, you talked a lot about corporations. What about sovereigns? If I replace, is the debt overhang problem not the same problem for sovereigns too, or what's different? Why shouldn't we not restructure than sovereigns, like in the euro area? Or?
Yeah,
Is any comments on that?
Marcus, this is probably a question you should answer rather than me. I mean, one of the problems with sovereigns is we don't have a bankruptcy process. So everything is a negotiation, as we've seen. I don't know, I'm going to ask you to weigh in on that. What's your take on, do you want to answer now or?
No, I leave it open. Let's
Yeah.
move on to the next item.
So the last question that I want to come back to is this question that Marcus left with his slides with, which is this issue about how to pay for credit subsidies. And you know, the credit policy in this world today is to some extent insurance. So I'll say this in a couple different ways. If you could have written debt contracts in 2008 that anticipated the possibility of a pandemic, then the right type of contracts you'd have written would be state contingent contracts in which, in the event of a pandemic, debt contracts would be written down. Right? Sort of the way in which we index, say, debt contracts for insurance companies with regards to big natural catastrophes. So you would write debt contracts in a way that debt would be written down in the event of a pandemic, and doing so would have avoided some of the issues that I have just discussed, which is debt overhang and bankruptcy concerns. To some extent, what credit policy is doing ex post is trying to find a way to fill in that contingency ex post. It's Chapter 11 is a way for doing this for large corporates, and as we've tried to say, that if you try to subsidize Chapter 11 filings, then you will do this in a more effective way. For SMEs, what effectively is happening, say with the PPP, is you're providing a large credit subsidy to a small business that's effectively allowing it to get out of its debt problem. I could say the same thing about workers. So if I'm a worker in a pandemic affected industry, if I could have written an ex-ante contract, the contract I'd have written would be one in which I'd receive an insurance payment while being furloughed from my employer during the pandemic. And the reason this would be beneficial is it would provide me insurance against, say, filing for personal bankruptcy, as well as having to reduce consumption. So that's the type of kind of ex-ante contract you'd like to write. And one way of thinking about credit policy of the government is it's essentially filling in this contract ex post. Okay, so I want to just take you through one slide of data as to how it's doing this, and this is from data on household credit assets. So on the left side here, I'm graphing the return on an index of auto loan asset-backed securities, credit card asset-backed securities, and mortgage-backed securities. So the underlying claim here is our households' payments on auto loans, credit cards, and mortgages, indexed to 1 at the beginning of this year, and then just tracking returns relative to the beginning of this year as we run through the year. So you'll notice that as we go through this period, this is the start of the COVID crisis where essentially all asset values fall. And then as we go back through, as insurance programs kick in, you'll notice that the credit card ABS now has a higher value than it did at the start of the year. The auto loan also has a higher value, and the mortgage-backed security has a higher value. So even though households have faced a fairly significant shock in terms of asset holders, it looks like the claim holders of the assets that are backed by household credit are expecting high recoveries, almost at the same level as they did at the start of the year. On the right-hand side, I'm just tracking credit card asset-backed security spreads. And spreads blow out in that March period, but they're back down now to levels similar to where they were at the start of the year. How is this happening? I think the answer, and we're seeing more and more evidence of this, looking on data looking at household behavior, is that the unemployment insurance in particular has essentially enabled increased savings among households, which have allowed them to make good on their on credit. And where does that benefit flow to? Well, it flows through the asset holder. So if you then think about taxation and how you can ensure the RWA allocation, one way of understanding the government programs is effectively the government has printed up T-bills and given it to borrowers who then use those T-bills to make payments to lenders in order to avoid bankruptcy. And you're avoiding the deadweight cost of bankruptcy by giving a borrower a treasury bill who can then use that as to make a payment. And those payments have been made. That is clearly present in the data. So if you had not made those payments, the lenders would have lost money and you would have had deadweight costs. That would have been the ex post implementation. In an RWA allocation, if you could have insured against this ex ante, what you would have done was to have had the lenders take the losses, but avoid the deadweight costs of bankruptcy. In a way, by doing so, you would have written the state contingent contract so that the debt would be written down so that no one would have to default. So if you were trying to restore or to replicate the RWA allocation, then the right answer really in this case is to impose taxes in a way that you take the T-bills away from the lender who's receiving this T-bill or this government money to avoid the borrower from defaulting. So our take on this is that to the extent that we have run through a recession and government policy that is insuring against damage, and to the extent that you were trying to do this in a way that replicates an ex-ante RWA allocation, the right way to do this is to take the benefits that have flowed through asset owners and tax them in the future in order to pay back the debt. So in some sense, taxes should fall on asset owners who have in a way been the beneficiaries of these programs rather than workers. So I'm going to stop here. So here are kind of our policy conclusions, thinking through kind of corporate finance of credit policy. One is, to us, it seems fairly clear that for SMEs, the right answer is to subsidize credit. There's quite a bit of thinking that needs to be done and is being done on how exactly to do this, but the objective of policy should clearly be to subsidize credit. For thinking about the large corporate sector, in our mind, there's less of a case you can make for subsidizing credit to large corporates. The corporate bond programs that the Fed has introduced last month, which were introduced initially as a backstop, should just remain a backstop. I don't think there's a good reason to scale them up. We do think that there's a good case you can make for reallocating subsidies not to currently distressed firms, but rather using them to reduce the direct financial cost of bankruptcy. That seems like a win-win in the world today, and in some way to also do something to avoid spillover costs by shoring up bank balance sheets. And then the last point, which I ran through, is that this particular recession is really one about insurance, and the credit programs fill in ex post an insurance allocation. And if you think through that, then the right way to think about the taxes that are making good on the credit programs is to understand that it should really come from asset owners. So I'm going to stop there.
Thanks a lot, Arvind. I have a bunch of questions, but one quick question is about, can you explain briefly how debt financing reduces the bankruptcy cost? Just a clarification question came up.
Okay, so if I'm a firm that files for Chapter 11, I need cash to maintain operations. Mm-hmm. And let's suppose that in the absence of a government program, I get this from the senior creditor, and I'm just going to make up a number. Let's suppose that the credit comes at a rate of 5%. That's the cost of running business during this bankruptcy proceedings. Imagine now the government replaces that 5% loan with a 0% loan. That's a reduction in the cost of business as I'm running through bankruptcy. So that's the sense in which you're reducing bankruptcy costs.
Okay, great. Then you talked a lot primarily about credit subsidies. What's about grants? I mean, there's a big debate, whether to subsidize credit or give grants right away. In particular, credit leads to more debt down the road, in a sense.
Yeah.
Can you shed some light on that?
Yeah. So let me comment maybe particularly in the context of other plans that people have thought about. I do think that makes a lot of sense. I think the worry with credit being used to deal with a credit problem is it basically loads debt on top of debt. Whereas really what you'd want to do is to find ways to reduce debt, and a grant does that. So I can think of beneficial programs to restructure debt so that debt levels are reduced and payment terms are expanded. Just as an example, you know, in the last crisis where we had a similar debt problem on the household sector, among the policies that were pursued are these HAMP and HARP policies, which the HAMP in particular allowed underwater mortgage households to restructure debts in a way that would extend horizons and reduce current payments. I think stuff like that makes sense. HARP was also a way for an underwater household to refinance down into a lower interest rate mortgage. So I think both of those types of programs make sense here because they allow for restructure. There's a separate type of program that can also make sense in this case, which is forms of capital injections that are not in the form of debt, but in the form of equity. So for example, I know you had Jeremy Stein here a couple of weeks ago, and one of the ideas that he has been talking about is having the government come in to, say, an SME and not lend debt, but rather lend and receive something like preferred stock or debt with warrants. And that eliminates this debt on debt problem. The challenge going down that road is it's unclear how you size the loan. How many warrants do you get, right? So in order for the government to come in and take a equity position in a small business, it needs to at some point make a valuation of what this business is worth and how many warrants it should receive to make this loan possible. The advantage of debt is it's essentially kind of information insensitive. This is what we know from finance, and so that avoids that type of problem. So it's a hard problem. I don't have a clear idea. What I know is very clear is finding ways to restructure debt that pushes out payment into the future is clearly kind of right. If you can find other mechanisms to avoid some of the future debt overhang problems, I think that's also great.
So Narayanan Bolusi, he would like to know about uncertainty. So one thing we know that during the crisis, uncertainty is shooting up. And many people argue that, you know, because of the uncertainty, people don't invest. Right. And you're arguing, including me, that it's the debt overhang problem which leads to less investment because you rather pay back your coupon payment, your debt obligations. But if I add in this debt overhang problem a higher uncertainty, essentially then the weight and the tail for the equity is actually increasing, and that actually would reduce debt overhang problem? So there are two questions essentially. One is it the uncertainty which causes low investment? And does uncertainty actually help to some extent to reduce the debt overhang problem because more mass shifts into the equity tail?
Right. So I'll say two things. First of all, clearly uncertainty, as we know, generally will reduce investment. That is, even if you're a world in which there are no corporate debt problems, so eliminate the corporate financing issues that we're living through, there are a collection of economic forces in the world which will reduce investment and expenditures. I think the credit policy question is take that as a given and layer on debt. To what extent does debt further exacerbate these types of problems? To what extent does debt exacerbate the recessionary conditions, part of which is uncertainty, part of which is reduced demand for your product? And that's the area that credit policy can potentially deal with. Now, uncertainty does interact with some of these issues that we have talked about. And I'll mention two places in which uncertainty interacts. First of all, I talked you through the case of a large firm filing for bankruptcy. And the way to think about that is that they own an option on the firm. And the private optimal decision for an equity holder in this case is actually, in the face of uncertainty, volatility is effectively higher, and so an equity holder would like to delay bankruptcy, even though a Chapter 11 bankruptcy allows you to get over the debt overhang problem. So uncertainty, thinking through the corporate finance of it, exacerbates another problem, which is it exacerbates the underinvestment problem, allow firm value to erode. So that's one place in which uncertainty shows up, affecting some of these corporate financing considerations we have raised. The second place where uncertainty shows up is just in thinking about the policy design question about the recession today. So, you know, we really don't know, and I'm sure many people have, many of you have had these conversations, which is, will the economy in 2 years be substantially different, or in 3 years be substantially different than it was in January 2020? Will the nature of the shock that we have gone through mean that there's just going to be a lot more stuff being done online, or in ways that the pandemic has permanently changed business practice? That is an uncertainty. And faced with that uncertainty, you know, kind of normally the economy restructures to in a way that fits the new blueprint of the world. But given that we're living through this period in which we don't really know where we're going to go, there's a case to be made for preserving current enterprise value and preserving current relationships as long as possible as this uncertainty is realized, so that eventually we kind of figure out where things need to go and we restructure. And that also, from a social standpoint, that seems to me that that should be entered into the policy objective.
Okay, very good. So let me conclude with a double question at the end. One is, you know, Joe Stiglitz, when he was on the webinar, he was talking a lot about super Chapter 11, which, you know, you don't restructure a single firm, but the whole part of the industry and take all the spillovers across firms into account. I was wondering whether this analysis would shed some light on these aspects as well. So there was a question about, you know, there might be even some other externalities which are health-related externalities. How would this change the picture? And then I want to end with the tradition in this webinar series that we always end at a positive note. So if you can give us a positive ending, some positive perspective.
Okay. So on the first question about Chapter 11, I do think it makes sense to think through kind of almost a COVID style Chapter 11. And I think it's worth understanding what type of bankruptcy process we would like that internalizes as many of these externalities as possible. And there are some thoughts there in the paper about effectively kind of designing a bankruptcy system in which some types of contracts like trade credit and, say, employee pensions are preserved through the bankruptcy process that minimizes spillovers, whereas other things like unsecured debt is the stuff that's restructured. So I do think that there's value in thinking through this and coming out with a plan that makes sense. It's a design question. Markus, on the positives, I guess I'm going to speak as a researcher here. I have to say that as a finance researcher, thinking through the last decade and research from the last crisis, there was a huge impetus to do work on banking as well as household finance. And we have seen both in finance as well as macro, a lot of good work in these two areas. It strikes me that this particular event, I hope that researchers come out of this going back to thinking about particularly small firms. This is an area in which we have, as researchers, fairly limited window. And I would look forward to research understanding how this recession has affected small firms, how policy actions have affected small firms, and how they end up affecting the economy.
Very good. Thanks a lot, Arvind. There are a lot of questions. I will pause. We will talk about them later on, in particular one from Ravi Jagannathan.
Okay.
But I think we have to close it today because we're running way over time.
Oh, sorry.
But
okay.
It was very interesting. I'm biased, of course. So again, thanks a lot for a very clear presentation. And I thank to the whole audience for hanging out till the end. And hope to see you next Monday again. So on Friday, we won't have a webinar. It's next Monday with Mike Spence, talking about the global pandemic effects of the COVID crisis. Thanks again, and hope to see you next Monday. And happy 4th of July weekend. Bye-bye.
Thank you all.